for everybody who missed it. So thank you, Terry Hancock, for coming to visit with us today. For those of you who don't know Terry, he's been a reverse mortgage specialist in the business for over 44 years. He's currently with SunWest Mortgage, and he's here to teach us on reverse mortgage for purchase, right?
That is absolutely correct, Shannon, and I want to thank you for inviting me to do this. I am, as Shannon mentioned, I've been in the business for a long time, since I was in college, and they tell me I know what I'm doing now most of the time, so that's pretty cool. And recently, I became the National Reverse Mortgage Director for SunWest Mortgage. And it's a product that I have been involved with for almost 14 years now, and I've seen it evolve. And one of the parts of the program that has evolved is the reverse for purchase option. When the program first came out, there was no purchase option at all, and it was very cumbersome. It was just a refinance product. But about 7 or 8 years ago, HUD and FHA rolled out the HECM for purchase, and it's become very, very popular. Today, what we're going to do is we're going to cover how it works, some general ideas on how it works. We're not going to, there's some, you know, obviously with any program, there can be some very specifics based on the client, but it is becoming increasingly popular. And most importantly, to the folks on this call, it gives you an opportunity to develop a marketing program for clients that are interested in purchasing a home using the product. Interestingly, there are 11,000 people every single day that turn 62 years old. And of course, this program is for seniors. And of those folks that are 62 years old, whether they're in retirement or not, many of them, like myself, continue to work, but 74% of those individuals intend to move at some point during retirement. So this is a terrific opportunity for you to market to these clients. Today, our objectives, we're going to just introduce you to the home equity conversion mortgage. We're also going to touch on our jumbo, which came out. We're going to talk a little bit about how the program works. Of course, the eligibility, and that always starts with being age 62 years or older. A little bit about the process. It's very similar to what we have on a regular mortgage. A little bit of information about the statistics, about what's out there, the demographics that are occurring in the United States, and also how the financial assessment works. Again, several years ago, there was some safeguards put into effect for this program to make sure that the seniors and the retirees were taken care of, and that the right people were getting the loan, and that they could still afford to pay their taxes, their insurance, HOA, and those kinds of things. So there was a financial assessment that was rolled out. So a little bit of basics. First of all, you got to be 62 years or older. Okay, it's the only time when you're older. It's a good thing, I guess you might say, because you get to have a mortgage where you don't have a mortgage payment. You have to be a U.S. citizen or a legal resident. Non-permanent resident aliens must meet FHA requirements, which basically is very similar to someone who is a U.S. citizen. At least one borrower must live in the property as his or own primary residence. The property must be owner occupied. This is not a product that is used for investment properties. You can imagine that I would have investors knocking down my door for this product if they could get a mortgage where they did not have a mortgage payment. But it is intended as a retirement program, and it's to age in place, basically, at a time in your life when you're typically living on a fixed income and just don't want to have the mortgage anymore. And all borrowers must receive an independent counseling service. This is a safeguard that was put into effect many years ago, something that SunWest and I really support, and make sure that the borrowers do understand how the program works. It's different than any mortgage they may have had in the past. And not everyone understands it as well as I do. There's some mortgage people out there that do originate these, but they don't know how to explain it to the client as well as I do, where I've really become dedicated to it over the last 15 years or so. The other thing you need to look at for the HECM program or the home equity conversion mortgage is that the maximum claim or the home value maximum is $765,600. The most popular program is the home equity conversion program, and that is this program. It doesn't matter where they live. They can live in Iowa, they can live in California. Doesn't matter. That is the maximum that would be considered. So if you had $1 million property, the maximum we can look at on the program is $765,600. This is fairly similar to, you may have heard about conforming programs where in the state of California right now, in Riverside County right now, the maximum claim is $510,400. So it's a very similar program. It's just not based on county. It's just across the United States. SunWest recently rolled out a jumbo program. So we do have a program that's proprietary. If you get a jumbo borrower, we can talk about it. I haven't even been able to update these slides yet, but I'll tell you a little bit about it. We can go up to properties that are worth $5 million, okay? So we can definitely take care of about anything we have in our Inland Empire area and pretty much anywhere in California. So it's a really good program, and so it is something that we do have and that is available. The home equity conversion mortgage is the fancy name for a reverse mortgage. So it allows you as a homeowner to convert some of your home equity into tax-free cash. In reality, equity in your house is just another pot of money. You may have other investments, IRAs, 401ks, or other investments. Equity, though, is another pot of money, and it's typically a little bit harder to get to if you wanted to use it later in life. You can either get a reverse mortgage, or you can get a standard mortgage. We have a mortgage payment. You can get a home equity line of credit, or you can sell the property. Those are the traditional ways that you would be able to use the equity in your home. Of course, the reverse mortgage allows you to stay in the home for as long as you want and never make a mortgage payment. In 2008, the Housing and Economic Recovery Act was passed, and there were some provisions that were put into that loan program that really helped the seniors, and it makes it a very safe program. Unfortunately, many years ago, there weren't these kind of safeguards. Some seniors were taken advantage of, and it just wasn't as good a program as it is now. There were many, unfortunately, people out there that took advantage of people. But now we have origination fee limitations, cross-selling limitations. You can't refi these loans until a certain amount of time has actually elapsed. And typically, it's not really a refinance program. The counselors need to be independent from the lenders, so they're independent fee counselors when we do the counseling. And of course, as we noted, the HECM for Purchase program is something that has become very, very popular, and what we're going to talk more about now. The HECM for Purchase is appropriate for borrowers who wish to purchase a new home without having monthly mortgage payment. Typically, one of the most popular programs is where they will downsize, moving to a one-level home or require handicap access. I also would tell you that there's a lot of people that are doing what I call right-sizing, or also very popular now is actually increasing the size of their home. So it's across the spectrum. I think downsizing is still the most popular, but it is typically, a retiree may not want to live in the big 3,000 to 4,000 square foot home that the family grew up in, and they want to move on to something that's a little more manageable because they want to travel and all those things. So downsizing is the most popular. Sometimes they want to be closer to children or grandchildren. I'm sure you've heard all these things. They may want to live in a 55 plus community, live in a neighborhood that is more social. The 55 plus communities are extremely social. And so it's a different time in their life, and it is a great opportunity to help the folks that want to do that. Builders and real estate agents can use this product to sell more properties. This is something that you can utilize, and we're going to show you some examples on how this would work. We have the same products on the purchase program that we do on a regular refi, the same limits, the same rates, any servicing fees, it's all the same. Of course, they need to make a substantial investment toward the purchase. And again, HECM for purchase only apply to owner-occupied primary residences. So this is the before or the after. Lived in the house for many, many years, and then we can move into something, maybe a single story, which is, you know, something that typically happens. I have a 2-story home myself. I'm 62 years old. I don't go upstairs very often anymore. Of course, I don't need to because our master bedroom and everything is downstairs. But a lot of seniors, as they get older, you know, going up the stairs is not a good thing to want to do. So there's very typically downsizing into the single story is very, very popular. So as we mentioned, actually I haven't updated this yet, but it's not 10,000 people a day turn 65. It's 11,000 a day that just got updated. And baby boomers are the main reason. Born between 1946 and 1964. And we're going to continue to retire steadily until about 2031. So obviously this is a huge market and something that you as a realtor can get involved with and make this a part of a focal point of your business. Of course, you can increase your listings, produce more sales, expedite closings. There's just more opportunities to work with builders in your community, especially in the 55+ housing options. It's just a great opportunity. One other thing that I've seen some recent data around here in our community, in the Empire. And I think you can see this by the number of new properties and new home developments where there are 55+ communities being included, is that there is a steady increase of retirees moving to the Inland Empire. I don't know the exact numbers, but I can tell you it's increasing. And if you think about the Inland Empire, you know, what we know today, you know, started in the early 90s. And you know, when I moved here in 1995, I couldn't find a house. I was looking for a new home. It was very difficult. I'm sure Carol and Shannon remembers a lot of that too, is, you know, it was hard to buy a house. And then everyone moved here, and it was basically younger families. It was families from San Diego County, Orange County, and, you know, even LA County that were moving here simply because the values were there. So they brought their young families to this community. And now, you know, they've grown up and there's other grandchildren, but moms and dads are moving here to be closer to the rest of their family. So that, I think, is a big reason why that is occurring. And I think it's going to continue to occur. I can tell you that, you know, I'm staying here. My kids are here. You know, it's great. It's just an example. I think a lot of us do. I have no desire to go sell my home and spend $1 million in Orange County. So I'm glad my kids stayed here. It's a lot more affordable, and a lot of seniors are looking at it from that perspective. The HECM for purchase strategy basically works around, instead of paying all cash, and this is typically what has happened in the past, is where a client sells a property and they typically, you know, have lived there a while and they have a lot of cash and they can downsize many times and pay cash. The option would be to not pay cash, but only put a portion of what they get from the sale of the previous home into the new home, and then finance the rest of it using the reverse for purchase option. Borrowers can save and invest more of their proceeds from the sale of their current home. So they're able to take money, and instead of putting it into their house, they can actually, you know, put a portion of it into their house and then invest the rest of it. I've also had clients that have actually bought 2 homes. They bought the home with the reverse for purchase, where they only had to put a portion down, and then they wanted a second home in Florida, for example. I just had one of those not too long ago, where the customer actually purchased a home for cash in Florida. So they were able to buy 2 homes using the reverse for purchase option. Client advantages, of course, is right sizing to a home that better fits their lifestyle. They never have a mortgage payment, less money out of pocket, and they live more comfortably and can upgrade their quality of living. So let's look at a couple of examples, okay? So we have a 70-year-old couple who sell their home for $500,000 and then want to purchase a new home for $350,000. And they do not want any monthly mortgage payments. On the left-hand side, okay, you can see how it would work without a home equity conversion mortgage for purchase. So you have a house that they sell for $500,000. They're going to have about 3% closing costs, maybe a little less, maybe a little more, who knows, but we'll use $15,000, which means that they have net proceeds of $485,000. They buy a new home for $350,000, which means they have $135,000 left over that they can give to their investment advisor or ever how they invest their money to live on for the rest of their life. The other option on the right-hand side is downsizing with liquidity using a HECM for purchase loan. So let's look at that. You have the same parameters, a home $500,000 with 3% closing costs means the net proceeds of $485,000. They buy the same home for $350,000. But instead of bringing in $350,000 to pay cash, the HECM for purchase enables them to only have to bring in $182,700, okay? So that means, excuse me, the HECM for purchase will be $182,700. So their down payment, the amount that they need to bring in is $167,300 instead of $350,000 cash. This means that they have $317,000 to invest with an investment counselor. So they're able to put more money into the bank or, you know, with a financial advisor and more comfortably live in retirement. I had a situation similar to this not long ago that I mentioned also, where my client, instead of putting the $350,000 down, had that extra, it was about $200,000. And they ended up buying that home down in Florida. They bought a second home, free and clear. They have family in Florida, so they're able to live here as their primary residence. But they like to go down and visit family typically around Thanksgiving time. So they have a home there that they're also going to live in. So you can use a lot of options with the extra money. However, you can see they have a lot more money that they can invest, which from a long-term standpoint will be very important to a retiree. Looking at number two strategy, okay, is where a customer wants to buy a home that is more expensive. And this happens a lot also. 70-year-old couple sells their home for $500,000. They purchase a new home for $700,000 and they do not want any mortgage payment. So if they sell the home for $500,000, we'll use the same parameters. Their net proceeds, this is on the left, are $485,000. The new home they want to buy is $700,000, which means that they have to come up with another $215,000 if they do not want a mortgage payment. So they have to dip into their savings or their investments for that $215,000. They could also get a mortgage, a standard mortgage, but again, this couple did not want to have any mortgage payment. On the right-hand side is upsizing with liquidity with a HECM for purchase. So again, we use the same parameters, $500,000 sale, which nets $485,000, buying a new home for $700,000. They get a reverse mortgage, the HECM for purchase, for $365,400, which means that their down payment is only $334,600. That means that they have $150,400 left over that they can add to their reserves and their savings. So if you do the math on that, instead of taking $215,000 from their savings, they're able to add $150,000 to the savings. So again, a great option, a great opportunity. I'm going pause right here, right now, and see if anyone has any questions. We're about halfway through, so I always find that this is a good opportunity and a good time to do that. So if you do have any questions, you can post it in the chat. I got to figure out how to do that, or you can just, we don't have that many people here on the phone, on the screen, but if you just have some questions, I'll be glad to take them.
I have a question.
Sure.
How does this relate as far as property taxes? Is it rolled in, or the owners still responsible for their property taxes on an annual basis?
Absolutely, you are still responsible. You can't get away without paying your taxes. You have to pay your homeowner's insurance. You have to pay an HOA if you have one. There is an option that it can actually be rolled in. It's not very inviting. It's not a really good program. I wouldn't advise to do it. So most customers, just do it with set up their own escrow account at the bank. And just have the money available when the bill comes in. And I personally take them through that, and I walk them through it very, very carefully, because a lot of folks have, over the years, always had an escrow account traditionally in their mortgage payment, right? They had a mortgage payment, and the taxes and the insurance and everything were just added into that. So I'm very careful to make sure that, they do have something set up, because when the tax bill comes, you got to have the money there. So I set up something that typically works. And basically, we just set up a separate savings account at the bank. And when the pension check or the Social Security check comes in at the beginning of the month, we just take a certain amount of money, transfer it over to that savings account, and guess what? It's there when the bill comes in. So I teach them how to do that. A lot of people get worried about that. But in essence, an escrow account that you have on your mortgage is just a fancy savings account. You can look at it that way. So
Right.
that's a good question. You do have to pay your taxes and insurance and all those other items. So that is extremely important to understand. Yes, Ms. Carroll?
Okay, can you hear me?
I can hear you.
Okay, so you know what, Shannon, that is a great question, because I had a client that had the reverse mortgage and was stressed about that. And she told me that she did get counseling, but it went in one ear and out the other. And it was shocking when they had to pay their HOA, their insurance, and their taxes. So thank you for saying that, Terry, because I know that these new people that I'm going to give you, they're going to ask that same question. But it's nice that you have the conversation with them before they go through the other stuff. So good question.
Well, I will tell you that, some of the safeguards that were put into effect several years ago were built around that, because the financial assessment, which we're going to touch on later in the presentation, was built around that. They wanted to make sure that seniors had the ability to pay those things and understood them. I always walk them through it. It's just something I've always done. I'm very hands-on when it comes to borrowers. So, I made sure they understood everything. But unfortunately, not everyone is as thorough as me. And there was a lot of problems, frankly, many years ago with clients who didn't pay their taxes, and there was no safeguard put into place to make sure they did understand it. So between the counseling, the financial assessment, and having the right loan officer is extremely important. If you have a client who ever comes to you who wants to use a reverse for purchase on a sale, that's great. But just make sure that they're dealing with someone who really understands the program. Very, very, very important. So
Thank you.
Me or someone else, get them to someone that makes really, this is what they do. This is their job. That's it. Not a regular mortgage person. I have a lot of loan officers that I work with, and it's a different loan. It's different. So understanding how it works is very, very important. Any other questions out there before we continue? Okay, we'll get going again. And I'm sure you can see this is extremely powerful on how you'd be able to, leverage it to help your client buy the home of their dreams instead of settling for something that's not quite as nice as what they would like in retirement. And I'm all for living your dream with your dreams in retirement. You've earned that opportunity to do so. So why not take advantage of that? So again, the advantages: buyers spend less money out of pocket, they can live more comfortably, afford a larger home. Another part of the reverse mortgage is there is a line of credit option. I've had clients who actually put more money down so that there is a line of credit. A line of credit is typically utilized on a refi, but it can be utilized on a purchase. And the great thing about the line of credit option is that it actually increases in value. It's not interest, it's what they call a growth factor. And it actually grows by somewhere right around 4% a year, guaranteed regardless of the value of the property. So heaven forbid if we had another 2008 again, which we never, none of us want to go through, okay, and the value of the property decreases substantially, the line of credit continues to increase no matter what. The customer also has access to it. They don't have any risk of the line of credit being decreased or even pulled, which is typically what happened with the line of a typical home equity line of credit that you would get through a bank when the values go down. Incidentally, there's several banks right now that don't even offer home equity lines of credit because of what we're going through right now, though values are stable. Chase and also Wells Fargo aren't offering home equity lines of credit. So it's a very safe option and it's a good option. Of course, borrowers can preserve their assets or even increase their assets. There is no FICO score is required, though the borrower must have satisfactory credit and property charge payment history. So when's the last time you heard that from a mortgage officer? No FICO is required, right? That doesn't happen. But we do require that they have shown good guidance in regards to their property charges, that they paid their mortgage in the past, that they paid their taxes in the past, that they paid their HOA, those kinds of things. That is the most important part of this. We still want borrowers that have the ability and also the good conscience to pay their mortgage payments. There are no employment requirements. The borrowers must meet or exceed the required residual income calculation. This is another safeguard that was put into effect several years ago to make sure that the client had the ability to make those payments. I will tell you, when I first started here, there was no residual income calculation, and it was from a standpoint of a loan being approved, it made it easier. However, a lot of those clients weren't able to make their taxes and insurance payments. So personally, I would advise them not to do it until they had extra income. But again, there were problems there. And of course, borrowers pay no mortgage payments at all for as long as they live in the home. Now, having said that, there is an option. If they want to make a mortgage payment, they can. I would say that if I made 100 loans to clients for a reverse mortgage, probably 95 of them do not make a mortgage payment. I would say that another, probably out of that, 3% of them just pay the interest so that the balance doesn't increase. And probably 2% of it, just 2% of them will just make a typical mortgage payment, at least while they still may be working. So someone who may work till age 70 and is getting a full income might be willing to do that. So, but typically the big lure, of course, is that there is no mortgage payment in retirement. This tells you a little bit about the mortgage insurance fund. I'm not going to bore you with it, but it is typically, you've heard of mortgage insurance that, on a typical regular loan. Well, these all have mortgage insurance also. They are there to make sure that the program works. If there's a lot of losses, guess what? We can't offer a reverse mortgage. So there is mortgage insurance that the client pays upfront, and also a small amount every month that is added to their balance. So it's a good program. It's just a cost of doing business. It is a part of the loan, and it's unavoidable. On our cash keeper, we do not have mortgage insurance, so that's on the jumbo, which makes it different. So that's a nice advantage if you get into a client who's got a higher valued home. Property eligibility, very similar to if you've ever sold a property or helped a client buy a property with the FHA loan, very, very similar. Single family has to be an approved condominium through HUD and FHA, which actually is kind of hard. There's not a lot of them approved, but typically single family home. Manufactured home is fine. That meets FHA requirements. I'm sure everybody's been through that. The home has to have been built and put on the original lot later than 1976. So really, really old manufactured homes will not work. 2 to 4 unit properties are perfectly fine, but obviously this is an owner-occupied primary residence, so the client has to live in one of those particular properties. PUDs are fine. Ineligible properties, co-ops, which we don't have around here. Newly constructed principal residence where a certificate of occupancy has not been issued. This is important. We can do a loan with new construction, but there has to be a CO. It's a little bit of a juggling act, and we work with the developer. They're kind of used to it now, so they know we can't do anything until the CO has been actually issued on the property. Boarding houses, bed and breakfast, existing manufactured homes built before 1976, and tells you a little bit more about that. But those are the same rules that we have on typical FHA loans that we may have dealt with. It has to be on a permanent foundation. They have to own the land, that kind of thing. Again, this is just a summary page about the eligibility, 62 years or older. We do have the ability to utilize a non-borrowing spouse, which gives them protection from losing the home should the borrower predecease them, okay? So where does this run into play? Well, sometimes you may have someone who's 65 years old but is married to someone who is 60 years old. The 60-year-old individual doesn't actually qualify for the reverse mortgage, okay, because they're not 62 years or older, but one of the borrowers does. So in this case, we would be able to do put the reverse together for them, but we would base it on age 60 or 60 years old. And the way the amount of money the customer received is based on their age, okay? So we don't do many of these, but it does come into play. Actually more on refis than it does on purchases. Most of the time we just tell the client, you know, you're better off waiting to age 62, and it's usually not that far away. And then we can put the reverse together for them. We do factor the age of the eligible non-borrowing spouse. The HUD counseling, as we noted, is always required. They have to move into the home within 60 days, which is typical on any mortgage that you have. And you have to be responsible for paying your property charges, your real estate taxes, insurance, HOA, or maintenance costs. By the way, and you have to do that on every single loan that you might have gotten to buy a house in the past. It's exactly the same. Sometimes you will see, even in national magazines and periodicals, you know, that warns seniors about a reverse mortgage because they have to pay their real estate taxes, insurance, HOA, or maintenance costs. Well, you have to do that no matter what, which is, it always is humorous to me that they cite that as a reason that you need to reconsider a reverse mortgage. You got to do that no matter what you do. And then, of course, they need to bring the difference between the purchase price of the home and the HECM proceeds to the closing table. Let's talk a little bit about principal limit factors. We use some different terms here than you may have heard. We don't use terms like debt to income ratio. I'm sure you've heard that before. We've got our own lingo here in reverse land. And HECM principal limit factors provide the percentage of the maximum claim allowable in total cash draws given the age of the borrower or the eligible non-borrowing spouse, and what's called the expected interest rate of the loan. I'm going to make this really simple for you to understand. The principal limit factors is the amount that they qualify for. Just think of it as what they qualify for. We have to use a fancy term there, okay? But that's the amount they qualify for. The maximum claim amount is the value of the property, purchase price, up to a maximum of the $765,600. So that's all you need to really remember. We use some fancy terms, but that's really where you're at. If you're using our cash keeper, which is the jumbo, we can go up to $5 million on the maximum claim amount. The calculation is based on the age of the youngest borrower and the expected interest rate. The expected interest rate is the rate that the investor expects to charge over a long time period. It's a calculation that is based on what's called the 30-year swap, which is a derivative. It's on Wall Street. It comes out every Tuesday, but it measures where rates are going to be over the long term. So that's what it. That's where it's how it's figured out, because they need to be able to make sure that there'll be plenty of value in the house as the customer lives there longer. And then we look at the lowest of the appraised value, the sales price, or the HECM mortgage limit, which is $765,600. Here's the other thing I want you to remember. The higher the value, the more the client receives. The lower the interest rate, the more the customer receives. And the older the customer is, the more they receive. Once again, one of the few times in your life when you're older, it's a good thing. Take those three components, it comes out, and we develop what's called a principal limit factor. And this is the amount the customer actually qualifies for. There's actually a table. It's hundreds of pages long based on every age and every interest rate. I just put it into a computer and it tells me what they qualify for. It's very, very simple. But again, the older you are, the more money you receive. As a rule of thumb, if you're working with a client, I can give you a little calculation you may want to write down. It's not perfect, but it's pretty close. But you can take the age of the youngest borrower, subtract 23, and that will be the percentage that we will be able to give the client based on the value of the home. So, for instance, if I have a 73-year-old individual, I would be able to give them 50% of the value of the home. Okay, that's the way it would be. So if you have a $500,000 home, they would qualify for $250,000. Means they would have to bring $250,000 to closing. The rest would be in the reverse mortgage. Now, of course, that loan to value is a lot lower than what you're used to seeing, because we can do regular loans with 0 down on a VA. We can do it for 3.5% on an FHA. We can do it with 3% on a regular conforming loan. But this is a reverse mortgage. And of course, the difference is that the interest will be added to the balance. So over time, so there has to be enough equity to be used to pay. There's no mortgage payment, so it is added to the balance. So if you ever need to know, you can call me, of course. But that's a very important part of this. It's very important. We don't have really low down payment type situations. The process is pretty simple. The customer typically goes through counseling, and I would add one more thing to this. They would actually sit down with me or a reverse mortgage consultant and really go through the program, understand it. I work with my clients before they get to counseling. And they do the counseling, and it costs $125 for the counseling. It has to be paid for by the borrower. In the state of California, I can take an application right after the counseling. However, we can't order any appraisal. We can't order any title or escrow until 7 days have elapsed. Only in the state of California is this a rule. It's called the cooling off period. So we just get everything else done, and the minute after the 7 days has gone by, we order the appraisal and get things going. We typically close our loans in about 25 to 30 days. It depends on the situation, but we're able to do them very quickly. There's a financial assessment that is done throughout the process. Again, we get the information from the client about their income, you know, and then we get their credit to see how they paid mortgage payments and those kinds of things. You know, it goes through a normal processing and then there's a closing. And it's typically 30 days or less. One thing that is a little bit different, we do get the appraisal. And of course, we all love that. And it is part of a process, just like it is on a regular loan. We have to turn those appraisals in to HUD the minute they're received, and they go through a filter at HUD, and there is a possibility that a second appraisal would need to be completed. And so that is just, again, another safeguard to make sure that the program works well. It needs to be, you know, the program has to be maintained. And, you know, if we have homes that are overvalued, you know, they have a risk component that they look into. So there is a possibility that there could be a second appraisal. Last I heard, about 25% of all the homes out there were having a second appraisal. And that's about what I typically see also. So, it's just part of the program, and it's there to protect the program on a long-term basis. Repayment. Now we get into the nitty-gritty. You're not making a mortgage payment. You could live in that home 30, 40 years. Who knows? People are living longer, and you've never made a mortgage payment. And you don't have to pay a payment until you no longer live in the home. So what does that mean? Well, that means that if you decide to sell the home, of course, you've got to pay it off just like you would any other mortgage that you have on a house when you sell a home. Or in my business, unfortunately, we deal with the inevitable when folks do pass away. And when the last borrower does no longer live in the home because they pass away, the home has to be paid off at that, the mortgage has to be paid off at that time. Now, importantly, there's no debt that is passed along to heirs, and there is no personal liability. You'll remember that we have mortgage insurance, and the mortgage insurance protects not only the borrower, but the heirs also. If you live in a home for 40 years or so, if you live a long time, there's a possibility you might owe more money on that home than it is worth. But the heirs have no responsibility. They don't have to worry about any kind of negative or, you know, what we call a short sale, I guess, in the old days. Remember that. So they don't have to worry about that. And there is no personal liability at all. No one. The only liability is by the house. It's based on the equity in the home. Once the loan is repaid, any remaining equity belongs to the homeowner or their heirs. So that's very important. So a lot of times I'll walk in and I'll be speaking to a client. One of the first questions I hear is, so is this where the bank or the investor owns the home? And absolutely not. They do not own the home. Banks and investors do not want to own homes. They owned many homes back, you know, we all remember the short sales and foreclosures and whatnot. They do not want to own homes, okay? They're in the money manipulation business, not the home business. They make money by, you know, by investing and by lending, and that's how they make money. It's not at all, the actual home is still owned by the borrower. They can sell it whenever they want. If they decide that they want to move after 5 years and move to a different state and get a reverse mortgage there, they can do that. That's not a problem. Though you can only have one reverse mortgage at any time because, again, it is a primary residence type loan only. So noted here, it's about lifestyle. Today's buyers want the whole package. They want to be involved with work and volunteering, family and friends. They love to have appropriate maintenance-free homes, 55+ communities, you know, easier to take care of. And of course, green and energy efficient properties are becoming very, very popular. And I would add one more on this too. You know, these, what we call, I guess, the next generation homes with the living quarters where, you know, mom and dad live at one side and the rest of the family lives on the other. I know that's become very popular here in the Inland Empire. And we can do that. We can do those kinds of loans, just mom and dad have to live in the house and it has to be their house. We do provide the client with an amortization schedule. And I'm just going to skip over this because I'm going to show you one. This kind of is the way it looks like, kind of gives you an idea of where the customer would be. And we provide this all the way up to age 99. It's just a what if. And it takes into consideration the value of the property increasing by 4% a year, okay, which is over a long time period is pretty typical, and we shouldn't have a problem. This is, of course, a straight increase in value. There's no way to say that values may go down a little bit or increase by 12 or 14%, which they've been known to do in the Inland Empire. But over time, it's pretty safe to say that 4% is going to be the right amount of time. I would caution also and tell you that this is not the type of loan where if your borrower doesn't intend to live in the property as a retirement home, or at least for 5 years, it's probably not the right loan for them, okay? It's for a long-term aging in place kind of situation. But you can see all the way up to age 88, yes, they would owe 1.1 million, but at that point in time, the value would be 1.474 million, which means that there'd still be some equity in the property at that point in time. If at age 88, we had one of those dips and there wasn't any equity, well, the family doesn't have to worry about it. If mom and dad pass away, it's covered by the mortgage insurance, and there is nothing that you have to worry about at all. Hopefully that doesn't happen, but we all know it does because real estate can go down in value. We don't like to think about it, but it does sometimes, okay? So that's just an example, and everyone is particular, and we do that to age 99. We spend a lot of time covering this with our clients. One other thing you should know about the reverse mortgage, there is one other time that you have to pay it off, and that is when you reach the age of 150 years old, okay? So if you get there, we'll worry about it then, okay? Now, the reason that is that a mortgage has to have an end date, okay? You just can't go on forever and ever. So definition of a mortgage, the legal part of it, okay, is that it has to have an end date. So that's the way they get around that. And if anybody lives to 150, I doubt the investor is going to kick them out, okay? So I'm not too worried about it, okay? But that's how they get around that. We work closely here. My slide is about financial advisors. We work closely with financial advisors throughout the process also. I actually get a lot of referrals from financial advisors because they have figured out that this is a good program, and they're actively encouraging, in many instances, their retirees to utilize this program. I just met earlier today in our building where I am, an accountant that I've known for years, and he's talking to a client this afternoon. He's going to advise them to use the reverse mortgage because it just makes sense in their situation. A lot of folks want to talk to their financial advisors, and I'm always there to talk to them also and explain it to them. Most financial advisors do understand how a reverse mortgage works a little bit, but I can share the particular situation for their client so that they can make sure it makes sense for them. So I'm willing to work with them at any time. There's been a lot of studies on reverse mortgages. Again, sometimes they have a bad reputation. It's unwarranted, but there is just a bunch of research that has been done over the years by some really smart people. I've actually had the privilege of meeting the gentleman right there, Wade Pfau, who's a retirement researcher. He has dug into this, and he's a part of what's called the American College in Pennsylvania. And they're pretty much, when it comes to financial advisors and the products that they sell, they listen to what the American College says. And if it's a good program, they will tell you so. If it's a bad program, they'll tell you so. And the American College has stated that, it is a very good option in retirement. But they're very popular, even more popular in other countries. Canada and Australia are probably two of the most popular countries that for reverse mortgages. They've utilized the program even longer than we have in the United States, which actually started in the mid 70s is when the program first rolled out. Just a reminder, the number of older Americans age 65 plus is projected to increase from 43 million in 2012 to 84 million in 2050. Wow, that's pretty cool. And that'll be about 21% of the population. So that means there'll be 92 million older Americans in 2060. That means there are an increasing number of eligible borrowers in the marketplace for this program, which can help you sell more homes. And that's why we're talking about this today. The financial assessment, we've already talked a lot about this. This is very important. It's something that the program it's a good thing. It's a little bit more work. It means we have to get income documentation, but we measure the customer's willingness and their capacity to pay their taxes, their insurance, and their bills. We want good people in this that have not only have the willingness, but also have the ability to do it. A lot of seniors go on a fixed income. Sometimes they have a little trouble adapting to that. I know that it's something that the way if we want to, right now we're all working out there, and if we want something special, we can just go sell another home. Seniors don't want to do that in retirement. They want to be able to have something that's very secure, but they also have to sometimes adapt to their lifestyle and to make sure that they have the ability to make the monthly payments. Credit is important. We do use the credit history analysis. We look at their debt and finances. Again, it's part of the whole process. We want to make sure that there are no tax arrearages in the last 24 months. And we have to make sure the homeowner's insurance is actually paid. We actually call the homeowner's representative and get a credit rating the old-fashioned way. Remember those things, Carol, right? We used to make phone calls and get a credit rating. We actually do that in this program. And sorry to pick on you, Carol, but I know you and I have been doing this longer than anyone, okay? And we have to just make sure there's a satisfactory payment history on mortgages, installment accounts, and revolving. So it's just, again, to make sure that the customer has the ability and the willingness to make their monthly payments.
Well, thank you for pointing out that I'm the oldest guy in the room, okay?
I don't know. I think I'm right with you, Carol. Don't worry about it. So in summary, a HECM for purchase is a great alternative for people age 62 years and older. And it's growing very quickly as far as its reputation, as well as seniors and retirees are just warming up to it more and more every day. It's a very exciting program. And I personally really love the program. And I've done over 300 reverse mortgages now in my career. And that means I have 300 people on my Christmas card list, okay? Because that is how I get to know these clients. And I've been doing it a long time. It's really fun, great customer base. And the other thing I should point out to you as realtors, they are great referral sources, okay? If they like what I do and they like what you do, guess what? They will refer more customers to you. My 28-year-old daughter, who I love dearly, her loyalty is not what mine is, okay? When she wants something, what does she do? She goes to the internet, right? She forgets who she dealt with. That's just the nature of, that generation, okay? Versus I keep tabs on who I do business with. And that the generation that you're working with in reverse mortgages tends to, give you a lot of business. So again, that's another reason that if you wanted to get involved with this demographic, you'll get more business from it also. You'll develop more relationships. I have clients that just call me every once in a while. I have customers that stop into the office every once in a while, and I love it, okay? And that's great. So it's a lot of the reason why I'm in the business, so.
Terry, I'm sorry, everybody, but I just want to tell you that we just got 3 buyers because of this reverse mortgage lady I'm going to be giving to you after this meeting. So it's very true that they are always appreciative and they will give you other buyers because they like that.
Absolutely. It's just, You know, it's just different. Again, my 28-year-old, she's just not as loyal. That's just the generation. You know, it is what it is. But the senior community, is just opposite. It's just a generational thing, I think, more than anything. So.
Hey, Terry, there's a question in the chat room
Okay.
about, can a couple buy a home with an RV that they intend to live in and still keep their current home? I assume the current home being the reverse mortgage home.
Absolutely, as long as they acknowledge that the home they're going to live in is their primary residence, so absolutely, it's not a problem. So if they're going to buy the house, travel the country, come back every once in a while, not a problem. One thing interesting is that they do keep tabs on you whether or not you're living there, okay? And it's kind of like checking up because, again, it's the spirit of the program. It's about aging in place. So, they send a letter once a year. Servicing sends a letter once a year, and it asks you to confirm that you do live in that house and it's your primary residence, okay? And so they're putting you on notice, that they do check, and that's okay because that's the spirit of the program. When you sign your loan documents, you also in like 3 or 4 places promise that it's going to be your primary residence. And, a lot of folks who buy regular homes, when they're younger, they turn those properties into rentals down the road. Can't do that here, okay? It'll catch up to you. So the spirit of it is that you do live in the home. But yeah, I have a lot of clients who have motorhomes, and we've done reverse mortgages so they can buy the motorhome. I mean, there's all kinds of things, okay? Because motorhomes are not inexpensive anymore. So
Right.
you can use it. Well, you can do that. You have to basically, you got to pay your taxes there. That's really what it boils down to. So.
Right. And I'm not sure if you answered this question. I did get a call about the equity to refi into a reverse mortgage. Did you answer that question?
Well, it's the same thing. Basically, again, you take the age of the youngest borrower, subtract 23, and that'll be about the amount of money that they would be able to receive. And so I just right before we took this phone call, I got a call from another loan officer in Phoenix, and he's got a client whose value of the home is $200,000. You've got a client who's 80 years old, but they owe $160,000. That's not going to work, okay? Because you'd be looking at about 52% of the value that I would be able to give to the client. So they would be able to give them about $105,000, but they owe $160,000, okay? So they would have to come to the table with some extra money. It's just not going to work. Now, in that case, what they're probably going to do is actually sell the home and downsize and get themselves like a $90,000 to $100,000 property, which you can still do in Arizona, I guess, and just downsize in retirement. So, there's a lot of, but that was an example of what you can do. I'm doing one right now. I actually got a customer right now who has a home that's worth $700,000. They are going to qualify for about $350,000, $360,000. They only owe $200,000 on the house. Okay, so they're going to pay off the $200,000, and they're going to put about $160,000 in the bank or give it to their investment advisors. So that kind of gives you an idea of what I do on refis. So refis are still a big part of what I do. But obviously, you folks are realtors and you want to utilize this as an opportunity to help you sell more properties.
Right.
Anybody over 62 years old, you should be thinking about this. And in my opinion, because it just opens the door. And I see a lot of retirees that settle for the house. They settle for something they think they can afford. And it's primarily based around the fact that they want to pay cash, okay? Or they don't want a big mortgage payment. And that's understandable. In retirement, you don't want to have to go get you're retiring. The goal is not to work. Maybe work part-time, but not to rely on that income. So you can do this, you can utilize the reverse mortgage. And, I can get, I actually not long ago just had a client's exact same scenario. They were living in Hemet, didn't want to live in Hemet anymore, wanted to get into something newer, and they couldn't find what they wanted because they just couldn't afford it. So the realtor brought them to me and we showed them how we could utilize a reverse mortgage. And now they have a beautiful home up in, I think it's it's either Banning or Beaumont. I can't remember. It's one of the B's. That's all I remember. Okay. Banning or Beaumont. And they have a beautiful home and they're so happy because they don't have a mortgage payment. And they got what they wanted, okay, in retirement. That's very, very important. So, you know, there's especially a lot of these clients have lived in a really nice home that they raised their family in, and you know, but financially they need to be able to you know, downsize because they're on a fixed income. So getting into the home that's very, very comfortable for them is extremely important.
All right, we have another question.
Sure.
As far as qualifying as your principal residence, can a couple live in a house or a homeowner live in a house 6 months plus 1 day to equal a principal, qualify as a principal residence?
That's correct. They have to live in the primary residence, the one we have the reverse mortgage on, for 6 months plus 1 day. Absolutely. That is the rule.
Okay, good question.
Yep. Who asked that question? That was really good. I can't see who's asking the questions.
That was Sarah Lee.
Okay, cool. I see the chat now. I figured out how to use it. Okay. Are there any other questions for me? Here's my offer to you, is if you have any questions, my number is at the, we're going to send this presentation off to you, Shannon. I'll send it to you. It's at the very end. If you go to the next screen, actually, you'll see my picture, and it's the last time you'll probably ever see me in a suit, okay, in that picture. But that is, I don't actually work on Orange Thorpe Avenue in Buena Park. I'm actually right here on Jefferson in Temecula. Don't call the direct line, call my mobile phone. I don't even know what my direct line is. My cell phone on it every morning at 7 o'clock in the morning till 10 o'clock at night, okay? Monday through Saturday, and I usually have it on a lot on Sunday too. But me anytime. If I don't answer, I will automatically call you back as soon as I possibly can. But I'm very attentive. I'm an old-fashioned loan guy when it comes to those kinds of things. I answer my phone and I call you back, okay? So I'm very willing to help in any way. I'd love to be able to help you, help clients realize their dreams. And that's really what it's all about. Retirement can be a really, really great time in people's life. Or it can also be, unfortunately, not such a great time because of financial pressures. Unfortunately, we do see that a lot, okay? So reverse mortgage can be a great opportunity to help someone with that. I've made some really big impacts in people's lives, and it's part of the reason I do it, to be very honest with you. So I really enjoy it, and I know the program inside and out, and that's why they made me the national director. And I'm teaching other people within our company how to do it, and that's a lot of fun too, because I really believe in the product. So anyway, that's all I have. Is there any?
You've given us a lot of information, and I agree with you. This is giving senior folks a lot of freedom to live a good life the rest of their life. So that's awesome. Thank you for coming today. Hope everybody enjoyed it. And I'll be sending this out to you guys so that you can look over it and give Terry a call as needed.
Absolutely. Well, thank you very much, Shannon. Thank you to everyone who was able to get on. I see some other friends that have gotten on. Diana, I see you there, and whatnot. So I can tell you that I'm here. Hi, Maria. I see a bunch of people. Gail, too. And Mr. Preble, my neighbor for the last 25 years. Yeah, I look forward to working with you.
All right.
Thank you, Terry. It was great. It was
Thank
really
you very
good.
much.
Yes,
All right.
thank you.
Bye, Carol.
Bye.
Carol,